This is an overview of deductions. I'm Leandra Lederman, and I'm really pleased to have a co-host today.
I'm Stephen Mazza. I'm a tax professor at the University of Kansas, and it's time to break into tax. We want to talk to you today about a conceptual framework for deductions.
So what this framework does is it puts trade or business on the left, personal on the right, and loosely speaking, investment or profit-seeking type deductions in the middle. The left two boxes in general fall on the deductible side, and the right box in general is the non-deductible side. So let's start with expenses as a subcategory of deductions. We'll get to losses later. For expenses, let's flesh out those boxes with some code section labels.
Code section 162 grants a deduction for ordinary and necessary trade or business expenses. Section 262 denies a deduction for personal and family expenses.
And section 212 allows a deduction of expenses for the production or collection of income and for the management, conservation, or maintenance of property held for the production of income. So that's the technical language in section 212 regarding this type of expense, which you might think of more informally as investment expenses.
Bear in mind that these categories are fairly broad ones. You have to look at other code provisions that may come in and limit or add additional conditions that you may have to satisfy in order to qualify for that deduction.
And similarly, just because an expense seems personal in nature doesn't necessarily mean that it's non-deductible. There are code provisions that may authorize a deduction for some personal expenditures, such as medical expenses or home mortgage interest.
An expenditure that may appear to fall within one of these three categories may, in some cases, need to be capitalized.
Capitalization is covered briefly in our Basics of Basis video, so don't miss that. The basics of capitalization are the idea that an expenditure is not currently deductible, but it creates or adds to basis in an asset.
An important code section associated with capitalization is section 263.
So in some, but not all situations, a taxpayer can recover the basis of an asset over time through depreciation or amortization deductions. Code section 167 authorizes depreciation for certain kinds of assets, and it's interesting to see that it actually covers two of the categories that are in the grid. The depreciation deduction in section 167A is authorized for property used in the taxpayer's trade or business or held for the production of income. But it's important to note that those two categories of trade or business and income producing property are not treated equally favorably throughout the entire code. There are definitely instances where trade or business deductions are privileged and expenses for the production of income are more limited.
A similar conceptual framework applies in the case of losses.
With respect to individuals' losses, it's really helpful to look at code section 165. Section 165A authorizes a deduction for losses, but for individuals, section 165C cuts back on that loss deduction and provides a limitation, limiting the loss deduction to three categories. Losses incurred in a trade or business, so the same category that we saw on the expense side of deductions, and losses incurred in a transaction entered into for profit, though not connected with a trade or business. This is different wording than section 212 and section 167 have. And then the third category is a particular subtype of personal losses. So losses not connected with a trade or business or transaction entered into for profit if the losses arise from some type of casualty or from theft. So there is actually an authorization of the deduction of some personal losses, but not all. So by contrast, Section 212 focuses on property held for the production of income, and that is the same language that is used in Section 167 as well.
Just because a loss may be authorized by a particular code section doesn't mean that it will necessarily be currently deductible. There are other limitations in the Internal Revenue Code that may deny that deduction if, for example, the loss occurs between related parties or if it's a capital loss.
Even though this conceptualization has 3 subcategories, it's important to remember that sometimes 2 of the subcategories are treated similarly. For example, in the context of bad debts, Code Section 166 distinguishes between business bad debts and non-business bad debts. So it actually groups together debts that arose in a personal context with debts that arose in an investment type context. And as usual, the trader business context is treated the most favorably. This has been an overview of deductions.
Thank you for joining us as we break into tax.
Please like this video, share it with your friends, subscribe to the Break Into Tax YouTube channel, and don't forget to turn on notifications so you don't miss a single new video.
Can you tell that my office is cleaner than it was when I did the last video?
Very nice.